Okay guys, so which company to invest? It's probably the biggest question when we're going to make an investment, is to find out how you can choose a company and whether it's overvalued or undervalued, or whether you should really be investing in this company. So that's when things can go right or wrong. And this really depends if you're following rumors or if you're following fundamental signs that gives a reason behind why you should invest in this company, whether their financial performance is going well. So this is what we're going to go through this video today, just going for some easy guidance on how you can see if a company is well valued, whether you should be investing on it or whether it's just a speculation and you are entering into a pyramid where you're going to buy high and lose your money. It's going to be an easy guidance, some tips really for you to make better decisions when you choose a company. So we're going to look for some very simple guidance on what you should be looking for when choosing a company. So for this example here, I'm going to use this app called Trading 212, which I found it to be very easy for beginners. And here we go. So I'm just going to pick a company here, ExxonMobil. So ExxonMobil is a company that is well famous for paying out dividends. So if you're looking for a company where it will be giving you a contribution of shares on a quarterly or monthly basis, ExxonMobil is one of them that can do so. But before you make the decision, just because they pay out dividends doesn't mean that they should be a company for you to invest. Things that can help you to make a decision is looking at the ratios. Yeah. So if you follow my Instagram page, then you've probably seen when I'm talking about PE ratios, EPS, P versus BV, so it's price versus book value. All these ratios can help you to see whether the company is valuable for you to invest. So looking at ExxonMobil as an example, market cap of 152 billion. This doesn't necessarily mean that the company is worth 152 billion. Is what the market is willing to pay for that company. And the PE ratio is 13.95, which really means is if you were to pay what you initially invested using your dividends, it would take you 14 years to get your money back, pretty much, to break even using your dividends. So if we go on EPS, so EPS is 2.59 and dividend yield 9.65. So, but how can you find out if the company is worth investing or not? When you look at the EPS for the last financial year, we got $3.19 and a revenue per share of $59.86. You can already see on the revenue of $59.86, that's way above the value of one share at the moment. If the share is $36 and the revenue of last year divided per share was $59, you already know that you're buying something that is less than what they can actually produce. You know you're already in a good position there. But you cannot base only on that. Another thing you should be also looking at for is the book value. So the book value is the net asset, right? After all the debts, how much is the true value of a company? So in this case, for ExxonMobil last year, it was $45.26, and you divide it by the value of the share at the moment, 36.08 divided by 45.29, you got 0.79. So that is meaning that the company is undervalued in terms of the value of the net assets by 20%. So here's your Black Friday. And in terms of dividends, you can see that the company is paying around $3.43 per year per share. And so if the current value of the share is $36 and they're paying $3 per share per year, and you got more or less 10% of dividends already there per year. So which is more than you can get in a savings account. And as you can see, the dividend per year Now, dividend per share for the last 5 years, in average, has been around $3.12. Okay, so if you want to look a step further on whether you should invest in a company or not, so what I use is this website called Simply Wall Street. The reason I use it is because it's very user-friendly. It gives you straight information on how the company is doing, but also some projections on what the company may look like in 2 to 3 years' time in terms of dividends, in terms of debts. So that's really handy, and it's free as well. You can look up to 10 companies per month. So if you're not a heavy investor, so I think 10 is a good way to start with a free version of this website. So just going through here, it's similar information what we looked at. You can see that the price of the shares back in 2019 was $70. So at the moment it's $36. So you got pretty much half of the value there currently. So in terms of this website, they look at the valuation of the company, and for them, the current price is undervalued, and the about right price should be about $44, which was pretty much about the price versus book value, which when we divided was about 0.80, so about 20% of undervalued. Another thing you want to look for is whether the management is also investing in the company. So what you want is a management team that have skin in the game. When skin in the game is they're also buying, they're also investing, they believe in the company. Because if you are investing in a company and you see that the management team is selling their stocks, something is wrong there. But for the case of ExxonMobil, you can see here that the last 9 to 12 months, they've sold a lot of shares, about $6 million worth of it. But for the last 6 to 9 months, they've been buying 68,000 shares, which is about $2.6 million. So that means, so you can see here as well who's been buying these shares. So pretty much the CFO, the Chief Financial Officer, has been buying 1.014 million of shares, and also the unit president, who bought $1 million worth of shares. So if the top management is investing as well, then there must be some good prosperity for this company. So pretty much, guys, what I'm trying to say here is that you should act like the bank. When you go to a bank and you want to borrow some money, what they look into your financial history to see whether you can pay back what you are borrowing. So then based on that, they decide what interest rate they're going to give you, and so on. So you need to take this position of as if you are the bank and you are lending money to the company. So you want to look deep into the financials to see, will this company be able to survive in the next 5 to 10 years? Are they going to innovate? Are they going to bring new products? Are they going to, you name it? So basically, you need to look into the companies that you understand. You should not take the ExxonMobil as a recommendation to invest, because this is the companies that I have an interest on. So I'm looking to whether I think they're going to succeed or not. So you need to pick the companies that you have an interest and look into the finances to see whether they're going to succeed in the next 5 to 10 years and whether they're going to multiply your money really. So guys, those are very easy guidance on what you should consider when you invest in a company, just to help you understand whether they are doing well financially. But if you want to know more information, I've posted a few posts on Instagram that gives a bit of information on ratios and how to develop your mindset as well in terms of investment. So if you found this video interesting, the next video I'm going to do is how you can invest with just £100. So if you're interested, follow this page, and then I will see you soon.